Hello, ladies and gentlemen, and a very warm welcome to today's session, which is an update on the South African tax. It's an excellent collaboration between myself, Sam Schenk, and Mariska de Bruin from Mint Accounting and Tax Advisory. So just before we get into things, the usual regulatory disclaimer, which simply says, and obvious to you all, I'm sure, is please do seek further qualified advice in relation to your own circumstances and your own situation before taking any action which may have an impact on your tax situation, your residency status, or any fees that you may pay, as any tax or the relief could change at any time. And the tax advice that we're providing today is a service separate from that offered of St. James's Place. It's a service that our guest speaker, Mariska de Bruin from Mint Accounting, can provide. So just by way of introduction, my name's Frederick Scholz, a partner at St. James's Place and a certified financial planner out of South Africa. I'm delighted to be joined by my colleague, Sam Schenk, advisor and partner at SJP, who's also from South Africa, as well as Mariska de Bruin, director of Mint Accounting and Tax Advisory based out of Cape Town. So Mariska specializes in helping South Africans living abroad and has helped many of our clients with their tax and investment planning. So it's great to see so many of you being able to join these types of events and that we're able to help. It is, though, hardly surprising given the differential tax regimes in South Africa compared to the likes of like Hong Kong, Singapore, or Dubai, where the tax systems and regimes are very different. So we're delighted that you can be online today and for us to share our knowledge. As we go along, please feel free to enter any questions in the Q&A box, which you should see at the bottom of your screens, and we'll do our best to get to each of them. If you would like any further confirmation or advice on your personal circumstances, just please feel reach out to Sam, Mariska, or myself. So just to give you a quick overview of what we'll be speaking about today. So starting off, Mariska will take us through the recent controversial South African budget, why it's so important to have your South African tax data up to date and the consequences if it's not, what the South African tax landscape looks like, and a couple of case studies on this. And then Sam will take us through what repatriation back to South Africa may look like and why tax efficiency and asset structuring is so important prior to moving to a highly taxable environment, as well as some of the most common considerations we come across. And then lastly, we'll have time to answer some questions at the end, which may arise throughout the session. So a quick summary of who we are at SJP. So we're a FTSE 100 company providing face-to-face advice, and we help over 1 million clients globally, managing around 190 billion pounds in assets. We have a distinctive investment management approach and tailor solutions to meet individual requirements, so making it easier and simpler for you to manage your wealth. Mariska, would you mind giving us a brief intro to yourself, Mint Accounting, and lead us into the first talking point, which is a summary of the 2025 budget, please?
Yes, thanks, Freddie. Okay, so I'm Mariska de Bruin. I'm a tax advisor and I specialize in expat and non-resident tax. And Mint is a specialist tax and accounting firm, also with a strong focus on expat and non-resident tax matters. And we focus on assisting clients to seize their tax residency, capital gains tax calculations, SARS tax directives in terms of anything they need in terms of non-residency, and then also tax advice for offshore structuring. I can honestly say that we are trusted by South Africans worldwide, and the reason for this is just because of our understanding of SARS regulations and the international tax treaties, which helps us help our clients to make informed decisions to minimize their tax and just in general to handle their global tax landscape. Our services include, but it's not limited to these, is expat and non-resident tax capital gains tax and SARS tax directive. So in terms of this one, what we also help clients with is if you're a non-resident and you sell a property in South Africa, then you might need to have withholding tax payable on the sale of the property. In certain cases, we can help clients to reduce that to a 0% withholding tax. And also, very importantly, is that if non-residents receive living annuities from South Africa, certain countries allow those living annuities to be exempt from tax in South Africa, and we help clients with those tax directives from SARS. We also do estate and succession planning, and then just accounting compliance and individual taxes. Okay, so we can go to the budget update. And first, I would just like to give a little update on the 24 budget that we had last year in our previous webinar. Is I think the big takeaway there was the two-pot system that was going to come into play on the 1st of September, which did happen, and it's in full swing now. And I think what I would like to share with non-residents, our experience with this is that when you are a non-resident of South Africa for 3 consecutive years, you can withdraw your retirement annuity fund from South Africa. And what we've been experiencing because of the two-pot system is that there's a delay in withdrawing your retirement annuity lump sum because of the two-pot system, just because now the fund house need to do a calculation of what is your savings available and what is the vested pot available. This is now to do with the two-pot system. So there's just a few delays that we've been experiencing in terms of that, but otherwise it's actually going fine. So yeah, just that update. And then in terms of the 2025 budget, I think all of us are aware, or I'm not sure if you were following this so much from Hong Kong, but we had a 0.5% increase in VAT. And then there's another 0.5% that they are saying will come into effect next year. This budget has not been passed yet, so we're not sure really what's going to happen. But I think the most important update that we did get from this budget speech is the impact on foreign pensions. So currently, if you are a non-resident of South Africa and you live in another country, you work there and you contribute towards your pension. So this is your foreign pension, you're contributing in a foreign country. If you then subsequently move back to South Africa and become a tax resident here, and then you start receiving your pensions as income in South Africa, currently that pension income will be exempt from tax in South Africa because you contributed towards it while you were a non-resident of South Africa. What the proposal is that exemption now gets taken away and that all foreign pensions get taxed in South Africa, regardless if you contributed towards it while you were in employment in a foreign country. And the reason for this is that in certain cases, it creates a double non-taxation, because if you are in South Africa and our exemption exempts your foreign pension, then in certain cases, the double tax agreement also exempts your pension in the country of source. So this just depends. All double tax agreements are different for different countries. But then because of our foreign tax credit in South Africa and the double tax agreement that exempts it in the foreign country, this person ends up paying 0% tax. So they just are avoiding that double non-taxation. It definitely has a negative impact on retirees because it could either be a non-resident of South Africa who always planned that they want to come back to South Africa to retire here. And now their foreign pensions are going to be affected, or maybe it's a foreigner who decided they want to come retire in South Africa. Their pensions will also now be taxed in South Africa. And I recently spoke to a client about this, and for them, he said that this was his whole plan, and it was calculated that way, that he's going to come and enjoy his tax-free pension in South Africa, and that's not the case now, and he might even decide not to retire in South Africa. So I do think this is a significant impact for non-residents, and it's something that needs to be planned for ahead of time. Okay, we can go to our consequences of ceasing residency and just a quick summary of how you can cease residency. So we have two ways of ceasing residency. And our first one that we look at is your ordinarily residence test. What we refer to here is what is your intention for the future? So do you intend to return to South Africa in the future after working or living abroad? And if the answer is yes, then you remain an ordinarily tax resident of South Africa. But if you say, I have no intention to come back, then you break ordinarily residence and you're not a tax resident of South Africa anymore. It could be that someone maybe took up a contract in another country for maybe, like 5 years or something, and they plan to come back. In a case like that, they'll remain an ordinarily tax resident, or someone that says, I want to come retire here. So then they remain ordinarily tax resident. We then have a second test also that can break your tax residency. So even if you remain an ordinarily tax resident, you can still break tax residency by the tax treaty rules. So the tax treaty rules are each country, all different countries, unique rules of how to become a tax resident of that country. For example, in Hong Kong, if you spend 180 days of their year of assessment in Hong Kong, then you become a tax resident there. So now we have you a tax resident in Hong Kong and a tax resident in South Africa, and you can only ever be an exclusive tax resident in one country at a time. So for that reason, we then go to the double tax agreement between South Africa and the foreign country, and there's a tiebreaker clause in the double tax agreement that will then determine which country has exclusive rights to making this person a tax resident. The tiebreaker clause has questions such as, where's your permanent home? Now, obviously, you have a permanent home in, for example, Hong Kong, because that's where you live. You go home every day. And then to have a permanent home in South Africa, that means that you need to have a property that's available in South Africa that you can just freely come back, walk into that property. Then you have a permanent home available in South Africa. If you have a property that's rented out, then you don't have a permanent home because it's not available to you. So in that case, you don't have a permanent home in South Africa, or perhaps if you sold your property and for that reason you have no property in South Africa. If that's the case, then you don't have a permanent home in South Africa, only in Hong Kong, and for that reason, you will then break tax residency in South Africa. This could be temporarily because you have the intention to come back in the future, but just to show how breaking tax residency can happen temporarily. Now, let's go back to the scenario where the person has a fixed property in South Africa that's available to them. Then they've got a permanent home in South Africa and in Hong Kong. Then the next question we would go to is to see, where does this person have their center and vital interests? So has your wife and kid emigrated with you? Or do you have employment in the foreign country? Does your kids go to school? Where did you set up your personal and business or economic ties the stronger? So if that's in Hong Kong, then you'll break tax residency in South Africa. If it's still, equally strong in both countries, then we will look at the third question, which is, where's your habitual abode? So then we look at, where do you spend the most time? And if you are in the foreign country for 5 years and you really only come back to South Africa for a holiday to come see your family, then you spend most time in that country. And for that reason, also you break tax residency in South Africa. If you spend equal amount of time in both countries, then we look at where the person is a national. And if the person is a national in both countries, then the tax authorities of these two countries need to decide. But we hardly ever go that far. It's always decided up in one of those 4 earlier questions. So just important note is that the date of ceasing residency will always be backdated to either the ordinarily test, the date that you left South Africa, or if you broke tax residency on the tax treaty rules, then it would be backdated to the date that you met the requirements. So becoming a tax resident in that country then. So it's backdated to that date. It's never on, like if you come to me now and say, I need to cease residency, but I left South Africa 10 years ago, we're not going to make your date of residency cease now, we backdated. And the reason why that date is important is because on the next slide, I'm going to explain how the consequences of ceasing residency, which is capital gains tax. So why this is important is that when you cease residency, there's an exit tax payable, in the form of capital gains tax on your worldwide assets. And the date that that trigger happens is the day before you ceased residency. So there are certain assets that's excluded from that, such as if you have fixed property in South Africa, that's excluded. If you are a beneficiary of a trust, but you only have discretionary rights, so no vested rights, and your retirement products, such as retirement annuities, pensions, providents, all of those things. But all the other assets will be included, and that will be deemed to be disposed of the day before you ceased residency. So I think where this becomes important is that you could have left 10 years ago and then built up quite a substantial portfolio of assets, and people get quite worried when they hear the need to pay capital gains tax, because now you've got this big portfolio, but it's not on the value of today, it's on the value of when you actually left South Africa. So in a lot of cases, it could be that there's no capital gains tax, or maybe much less capital gains tax because you left long ago and you held less assets at that time.
Jump in there because we've had two good questions which have come through just with regards to tax migration, seizing tax residency. So the first question, which is two parts to the question, an individual has left South Africa 10 years ago and has been paying tax in the new country. Do I still need to formally seize tax residency? And what happens if I'm planning to move back to South Africa in the future? Is it actually worth going through the tax migration process?
Okay, so if you left 10 years ago, then I think if we go back to the ordinarily residence in the tax treaty test, then you can see that you would definitely have met the requirements already to seize tax residency. So if you left 10 years ago, regardless if you're paying tax in the foreign country, that you don't automatically become a non-resident of South Africa. So SARS would see you as a tax resident living temporarily abroad, and South African tax residents are taxed on their worldwide income, whereas non-residents are only taxed on their South African source-based income. So if you've been there for 10 years paying tax there, SARS would actually expect you to declare that income here. And obviously the tax that you paid in the foreign country would be a tax credit in South Africa, but there might be a shortfall. And there's a lot of tax triggers that can happen during this time when you didn't seize residency that could definitely put you in a difficult position. And then to come to the point of, is it worth seizing residency? So it's not a question of, is it worth seizing residency? If you meet those tax treaty rules and the double tax agreement makes you a non-resident of the foreign country, it becomes an obligation to seize your residency. So SARS deems that an obligation. So you have to inform SARS that you have seized residency. And in many cases, that can save you from a lot of tax risks over the years of just not informing them.
Okay, so very important to get things in order then. So the second question is, what happens if I never officially tell SARS that I left? Will they eventually catch up with me?
Yeah, so I mean, SARS can definitely. There's the common reporting standard between, I think there's 92 countries on that list. But I think what I would urge people is, I recently had a client who left 20 years ago, and he never informed SARS that he ceased residency. And during that time, he obviously had all sorts of transactions happening. And I think 7 years after that, he came back to South Africa, just, temporarily wanted to spend some time here, but he never wanted to become a tax resident again. During that time, COVID happened, and he got stuck in South Africa. He couldn't leave South Africa because of all the limitations of traveling. And because of that, he became a tax resident of South Africa again during that time, because we have the physical presence test. If you spend a certain amount of time in South Africa in a 5-year period, you become a tax resident of South Africa. So what the consequences for him was that when he left 20 years ago, there was no capital gains tax payable because he didn't have assets that attracted capital gains tax. Then he built up a substantial amount of assets, and he ended up in South Africa, got stuck here, which means he became a tax resident. And then when he left South Africa after everything was lifted after COVID, he then broke tax residency again because he's now going back to where he came from. What then happened, there's another trigger of his capital gains tax. And at this time, he now has this big portfolio of assets, and now he needs to pay capital gains tax in South Africa because of that trigger of making him a tax resident and breaking his tax residency again. So, and on top of this, during this time, he also made donations to an offshore trust that he created. And if he was a resident while doing that, he would have needed to pay donations tax in South Africa. So he unknowingly left South Africa, thought everything was fine, but all of these things triggered, and now he needs to pay SARS a lot of money in the capital gains tax because of breaking tax residency, seizing and becoming a tax resident again, and then breaking tax residency again. So I think there are definitely triggers that can catch up with you, which you should be more worried about than SARS catching up with you.
Cool, perfect. Thanks a lot. I'll shift to the next slide for you.
Okay, thank you. Okay, so SARS tax clearance process, which we call an AIT PIN, it's called an approved international transfer. And why this is important is that when you are a non-resident, you need to apply for an AIT PIN for any funds that you want to send out of South Africa. So if South Africans want to send funds abroad, we get the first 1 million rand every year that we can just freely send funds abroad. But if you're a non-resident, you lose that single discretionary allowance, and you need to send or apply for an AIT PIN for any funds that you want to send abroad. There are certain exclusions, but for these exclusions to apply, the prerequisite is that you must have ceased your residency. And this is exchange control rules, so they will allow you to send your living annuity abroad, or your salary payments from a South African employer, or inheritance in certain cases. Exchange control will allow you to send that funds abroad without an AIT PIN if you have ceased your tax residency. Then a few examples of when you will need an AIT PIN is if you sold your property in South Africa maybe and you want to send the proceeds abroad, if you had disinvested your assets or drew your retirement annuity products, or maybe your granny gave you a donation and you want to send that money out of South Africa, or your inheritance, again, in certain circumstances. And then if maybe you had dividend payouts or savings, or, any other funds that you want to send out of South Africa, you'll need that AIT PIN. Now, it's very important also to note that if you, like our question said, I've been living abroad for 10 years and I've never told SARS at all, and in this case, you get an inheritance, or maybe, the donation, or you sold your property finally. In this case, you will need to cease your residency before you can send the funds abroad, because one of the supporting documents for the AIT PIN is that you must prove that you've ceased residency. So why this is important is because the AIT PIN distinguishes between residents and non-residents. So everyone applies for the same AIT PIN, but you need to say I'm a resident or a non-resident. And if you've been living out of South Africa for 10 years, you can't say I'm a resident. So that's why it's important to seize your residency, to make sure that when you want to send funds abroad, you don't first have to go through that process. It takes a month to seize your residency, but there could be other delays, like maybe you need a tax residency certificate from your foreign country to seize residency, or there's other documents that you need that maybe creates a delay, and then that will create a delay for you to be able to send funds abroad. So again, also proactively seizing your residency can help with so many things. Supporting documents that SARS wants, I think important that I need to mention is that the AIT PIN, you can apply up to 10 million Rand, and then you can do a special approval for over 10 million Rand. And then the supporting documents that SARS wants for that is, let's say your funds that you're sending out is from the proceeds of your house, then they want that source documents to prove where you got that money. So it would be like the deed of sale of the property, or the statement from the conveyancer showing the funds went to you, and then always your bank statement where the funds are reflecting in your account. So that would be the source documents. And then about 2 years ago, SARS changed this process where you need to always submit a statement of assets and liabilities, 3 years worth of statements of assets and liabilities. But 2 years ago, they changed it to include worldwide assets. Before, it was only South African assets. And I think this, this has been causing a lot of stress, I think, with a lot of non-residents, because all of a sudden they now need to tell SARS of their worldwide. assets. And on top of that, you need to list it at what the current market value is, and then also what you paid on that. So SARS is always aware of what assets you had and what the possible capital gains tax could be, if that's applicable. They also ask additional questions, which also created a lot of stress for people is, are you a beneficiary of a local and a foreign trust? Have you made loans to these trusts? Or do you have direct or indirect shareholding in a local or a foreign entity of 20% or more? So yeah, I think that's just caused a lot of stress, but it's really not. It seems like a lot of paperwork and stuff, but it's really actually quite simple if you do the right things. And then, like I mentioned, if you're a non-resident, the additional supporting documents that SARS wants is the proof that you have ceased residency, and SARS issues you with a notice of non-resident letter once you've ceased residency. And then also they would want the capital gains tax calculation to prove that you've paid exit tax, if obviously that was applicable. Okay, so we can move to the next topic. Okay, so a few case studies that we have is the first one is a South African trust with non-resident donors and non-resident beneficiaries, and how the taxing of that will work. So in this case study, we have a family who spent years carefully building a trust to secure their family's wealth for future generations. They ensured that everything was structured for asset protection, succession planning, and long-term financial security. But what if the trust designed to protect their wealth suddenly became one of the most heavily taxed structures? This is what happened for the Horizon Trust. Originally, it was set up for a South African family, but the trust tax treatment drastically changed when the donor and all the beneficiaries immigrated from South Africa. What happened from that, or what the result is from that, is a 45% tax trap that turned a strategic wealth preservation vehicle into a tax liability. So what happened and how we can fix that, I'll explain that now, or how we can mitigate all of that. So first, I want to just explain how a trust's income is taxed. And in South Africa, we have a flow-through principle, which determines how the income needs to be taxed, and it will always be taxed in this order. So it will always first be taxed in the hands of the donor. So if there was a donor who donated assets to the trust, or maybe they gave an interest-free loan, which creates a donation, or any settlement that they made to the trust of an income-bearing asset, they could be taxed on this income. So there's attribution rules, and an example of one would be, let's say this donor donated his rental property to the trust because he is in the 45% tax bracket. And because of the flow-through principle, what happens there is that if the trust earns income, it can distribute this income to the beneficiaries, and then the beneficiaries will be taxed on that income and not the trust. So let's say this donor then donated his rental property to the trust, and he said that, I want my wife, my kids to rather pay the tax on this income because I'm already paying a lot of tax. My wife's not working, my kids are minors, so they're not going to pay a lot of tax. That's avoidance of tax. So there's anti-avoidance rules that said if you donated this property to the trust for the pure reason of saving tax, then if you give it to your wife and your kids, then you, the donor, will still be taxed on that income. So regardless if the income flows to your wife and your kids, you'll be taxed on the income. If you gave the asset to the trust or donated this asset to the trust purely for the reason of succession planning, or maybe to reduce your estate duty tax in the future, then there's certain times when the attribution rules won't come into effect. So, for example, if your wife then receives a distribution of this income, you won't be taxed on it. Your wife will be taxed. Your minor kids will always be taxed because that's just a normal anti-avoidance rules. There's many other of these attribution rules, but I'm just going to stick with this one simple example. So I go back to the order of the trust being taxed is the donor if the attribution rules exist. Then secondly, who will be taxed is the beneficiary. So if the income is vested in a beneficiary, maybe the trust deed says that all the rental income is vested in the beneficiary, so they must always receive all this income. or maybe in this here, this trust has discretionary rights. So the trustee said that we've made a decision that we will distribute all the interest income to the beneficiaries. Then that income will be taxed in the hands of the beneficiaries because they're receiving the income, and they'll pay tax on that income. Unless, of course, the attribution rules of the donor exist, that will always override it. So first donor, beneficiary, unless there's attribution rules. Then thirdly, the trust will be taxed if there's no donor with attribution rules, or maybe there's no beneficiary who's taxable. Then the trust gets taxed at 45%. So we can go to the next slide where we look at a few aspects. So another attribution rule that I want to mention that is specific to non-residents are that if you are a non-resident of a South African trust and you receive a distribution from this trust, then the attribution rule says you as the non-resident cannot be taxed on this. The resident needs to be taxed on this. So that would then either be the donor gets taxed on it, or the trust gets taxed on the income that you as a non-resident beneficiary receives. And the reason for that is because non-residents pay much less tax in South Africa. So again, just an anti-avoidance rule. So the problem that this Horizon Trust now has is that because the donor immigrated from South Africa and the beneficiaries immigrated, there's no South African resident to tax. So for that reason, the trust is the only one left to tax, and that creates the 45% tax trap. So this creates a major tax burden because this trust was structured that all the income gets flown through to the individual beneficiaries and gets taxed at their individual rates, but now all of a sudden there's no one to tax, so it's going to be taxed at 45%. So just to illustrate this by this example is that the Horizon Trust receives R1 million in profit from all its income-bearing assets, and now because the donor can't be taxed and the beneficiaries can't be taxed, only the trust is left to be taxed, and at 45%, the trust pays 450,000 Rand tax on that R1 million profit. That's far higher than, let's say there were 4 beneficiaries and the R1 million was split equally between them. They would have each received 250,000 Rand, and that 250,000 Rand would have been taxed at 26%. So that's much less than the 450,000 Rand that this family now loses on their income. So we can go to the next slide for key considerations and what can we do in a case like that. So it doesn't have to end there. It's not just doom and gloom. We can obviously structure and create future plans for this trust. If all the beneficiaries are non-residents, we need to reassess whether this trust remains suitable, or we could sell or restructure some of the assets, which obviously will trigger capital gains tax, but it will protect the trust on the future growth. So, everything from this date will have a growth, and in the future it will be taxed at 45%. You can definitely protect it against that. Even better would be if before the family immigrated, they vest all these assets in the beneficiaries, which will then attract exit tax in the beneficiaries' hands at 18% versus when the trust sells it, it pays tax at 36%. So you save already 50% on the capital gains tax that you need to pay. Another structure could be that if this is a permanent immigration, you could consider offshore investments or creating a trust in a tax-efficient jurisdiction. Obviously, the capital gains tax that you then paid in selling or restructuring these assets, that can be recovered over a period of time with better tax and financial planning. Also, to plan for the trust future is to just see, is there going to be any distributions? What will the tax implications be, and plan for that? And then my advice would always be to get a tax opinion, restructure, just to make sure that you get the most tax efficient plan for your trust. And we at Mint specialize in this. We can help you with tax planning and opinions and any restructuring plans that you need to do. Then in conclusion, on the next slide, it's important to note that when a South African trust non-resident donor or has non-resident donors and non-resident beneficiaries, it could become the least tax efficient structure that exists. So just important to keep that in mind. And then also, if this Horizon Trust in our example, they created a lot of efficient tax planning tools, but this can become a financial burden if they don't evolve with the immigration. So if you have a trust and there's beneficiaries who have immigrated, it's very important just to look at the structure again and redo that. And then if you can at all plan before the family immigrates, vest the assets in the beneficiary so that you can avoid the 36% capital gains tax and the 45% tax trap. And then also just very important to remember that a trust is not a set and forget structure. It's something that regularly needs to be looked at. And especially if this family is moving globally, it's very important to look at to avoid unnecessary tax for this family. We can go to the next topic. Okay, so also a very important topic, I think, in the world of global residency at the moment is inheritance, because your family and your trust and everything was set up for South African families, but now everyone is immigrated. So in this case study, we're going to look at like tax residency in terms of inheriting funds. So we've got Mrs. Legacy here who done everything right, and she built her wealth locally and abroad. She planned her estate and she ensured that her beneficiaries was going to be taken care of. But one overlooked detail nearly locked her legacy in South Africa indefinitely. Her beneficiaries, who's expecting a smooth inheritance, instead could have been facing months or even years in red tape, unable to access what is rightfully theirs. So we created an amazing plan for Mrs. Legacy to avoid the financial disaster that she possibly could have faced, or her beneficiaries possibly could have faced. So beneficiary one is a South African who emigrated 20 years ago, but she never informed SARS that she emigrated. She's lost her South African ID and she has no record of her ID number or her tax number. So I can't identify her with SARS to find out, what her tax number is, because I don't have her ID number. And for this reason, because I can't identify her, I can't seize her tax residency with SARS. Beneficiary two also immigrated 20 years ago. He, at that stage, placed his immigration on record with the Reserve Bank, but he's got no proof of that. He's got no record of anything. And he doesn't want to go through seizing his residency now again because he's scared that he will trigger issues in the United States. Then we have beneficiary three, who is Mrs. Legacy's niece, and she left South Africa when she was 11 months old. So she was never a tax resident of South Africa. She never had a tax number. So for that reason, she had never had any tax ties in South Africa. On the next slide, we look at the implications that this has for her will. And to do that, we need to look at the South African exchange control rules when it comes to inheritance. So exchange control says that if you're a South African, or it could even be a foreigner who ever had a tax number in South Africa, then they'll allow you to send your inheritance abroad if you can prove that you've ceased tax residency in South Africa, and also you'll need an AIT PIN to be able to send that funds abroad. So the problem that we have here is that because beneficiary one doesn't know what her tax number or her ID number is, I can't seize her residency because I can't identify her with SARS, and beneficiary two refuses to do so. So their inheritance would be stuck in South Africa. They will be unable to send this abroad. Exchange control will block this. So exchange control rules for someone who has never had a tax number in South Africa before is that you can send your inheritance abroad freely, up to 10 million rand. You don't need a tax number, don't need any seizing residency or anything like that. And if your inheritance is over 10 million rand, then we can apply for a manual letter of compliance from SARS. Again, you don't need a tax number, you don't need to seize residency, you only need that letter. So it's a little bit easier than for someone who actually had a tax number. So in this case, beneficiary three never had the tax number. She will be able to send her inheritance abroad. So we came up with a strategic plan for Mrs. Legacy, and she changed her will accordingly. She left her South African assets to beneficiary 3, her niece, who's the only one who's going to be able to send her funds out of South Africa. And then she changed her foreign assets to be inherited by the 2 non-resident beneficiaries who would have had the problems with SARS. So we were able to turn this around for her. On the next slide, we can look at some key considerations. Freddie, if you can please go to our next slide, please. Thank you. Okay, so things to consider for your inheritance or your will in South Africa when you have non-resident beneficiaries is make sure that they know what their tax residency status in South Africa is, to see, would they need to cease residency now? Is there anything that can be done ahead of time to avoid the red tape if they had to inherit from your estate in the future? And then non-residents with no South African tax number can freely send funds abroad. So that's important to remember when you choose your beneficiaries. And then also just to keep in mind that proactive planning can prevent delays in terms of residency statuses. Because if Mrs. Legacy left her will like this until after her death and she never did the planning, her funds would have been stuck in South Africa. So by restructuring her will, she ensured that her non-resident beneficiary can take out her South African assets, and her non-resident beneficiaries weren't stuck with all these problems with SARS and SARB, so they can easily receive their foreign inheritance. So just, I think that the takeaway lesson here is that estate planning isn't just about a will, it's about avoiding residency traps before it's too late.
Yeah, thanks very much, Mariska. Really appreciate that the tax update or budget updates and as well as pretty practical examples, I think were quite good. So it's really nice to see how they have been used in previous cases. And obviously each one is individual. So thanks very much for that. Now, moving on to the topic of repatriation back to South Africa. When moving from a tax efficient jurisdiction to a higher tax environment, planning is actually obviously essential. So yeah, 9 of the most key points, which we have found to be crucial in planning a move back to South Africa. The first point, one of the most important to get correct and understand, is your tax, obviously. When leaving, it's just vital to close and settle any tax liabilities in the country where you have been residing before departing. Understand your South African tax status as well as your domicile. You also need to be very cautious and aware of possible future tax changes and how this will impact you or your family's financial planning. Moving on to the other one, the currency exposure and risk, second top right there. Considering upcoming market uncertainty, we need to remove any currency risk. Just ensure that your underlying assets are stated in the correct beneficial jurisdiction, removing any short-term noise affecting our sleep easy at night test. Thirdly, moving on to the middle row, we just need to review your existing investment and insurance arrangements. So things to look out for is their current structures, how these may be treated on your future moves into a new jurisdiction so that these are understood and can be navigated easily. Within your investment, the asset allocation is a key factor to avoid concentration risk, which includes, for instance, having all of your salary and insurances with an employer or just your employer, or all of your money tied up in an illiquid or non-interest earning asset. And we can just raise any flags to just make sure you are aware of all of the associated risks. We ensure you are aware of any tax-efficient investment vehicles, which provide you with an excellent platform to invest and manage investments, while at the same time protect or defer capital gains and dividend tax liabilities. The middle one here, property arrangements. So we'd also suggest that you review any fixed assets, such as residential, investment, and commercial properties, as well as including the mortgages and loans. Look at the timelines and intentions for realizing these. Understand the market rates and the impact of these assets or loans on your overall financial plan and how to best structure these to complement your specific situation. The cash management or banking savings cash flow, essentially, that's one on the far right. This will be just to monitor your current lifestyle, your expected lifestyle and goals, incoming or outgoing cash flows or milestones, and how this all maps out. Are the taps going to run dry? Do we even know what it looks like even? Don't leave this to chance, where you can build a robust plan with the help of a few simple tools which takes out the uncertainty of whether you will actually achieve your goals or need to make any lifestyle changes now or in the future. Moving on to the bottom row, the personal financial administration and portfolio management, just ensuring all of your assets are working in the same direction towards your ultimate goal, whether it be wealth accumulation, consolidation, or just intergenerational planning, again, specific to you. Pension and retirement planning, it's another big one over here. Again, this is also critical to have in place, even if not in the traditional pension manner. So contributing a portion of your income every month to your own personal pension plan, much like an employment or provident fund pension, is just key to ensure you are in control of your own future and not dependent on an employer and a false sense of security this brings for now. Also considering that's potential concentration risk, which I mentioned earlier as well. So again, this on the pension and retirement planning still. This can be reverse engineered through flexible or robust goal-based financial planning, maneuvering the tax implications along with an investment strategy to just ensure both are considered. The first step here would be to understand what income in retirement looks like, when this may be needed that you would like to start receiving passive income from your investment portfolio, and how your pensions globally are structured or taxed, much like Mariska mentioned. And then this will be a good guidance specific to the actual individual, which allows for a solid foundation for retirement or pension planning, kind of good first step. The second last one there, succession and intergenerational planning. Here, it's just key to have wills and power of attorney in every jurisdiction, as Mariska was also saying earlier, but just in every jurisdiction in which you hold assets, have any operations, any involvement in, just to ensure that should the worst happen, your estate can dictate the probate process within your wishes, as sometimes it can obviously take years if it's not done correctly to be resolved. And then also the eventual beneficiary status is also key, as Mariska was also mentioning. If they are living in South Africa or abroad, we usually get it right. And it's a case-by-case kind of status. And then lastly, the last one. So it's close off all of your accounts, visas, or permits, just to ensure there's a clean cut in the jurisdiction, should this be the correct thing for your requirements. Although it may be that you should keep certain aspects open for tax management in retirement through being a permanent resident in a lower tax jurisdiction, just to ensure that you can achieve your planned lifestyle, fitting in with your international way of life. Really. Okay, and then just on the last one, essentially, there's just a couple of considerations from our side to note when living or considering living abroad, which we think are just vital to know and take advantage of ASAP. Number one, the first one at the top there is the depreciating currency. So the Rand versus the USD or any major international currency has been depreciating at a rate of about 5% per annum for the past 10 years. We've also got Trump and his impact on the USD and the associated uncertainty here for the upcoming next 5 years. And so, again, just being aware and removing any currency risk here is essential. The geopolitical issues or instability back in South Africa regarding the land grab or expropriation of land from farmers is a constant buzz around the country, along with the likes of Julius or the ANC issues. They just don't really bode well for a stable economy at the moment. Again, just things to be aware of. There's also investment restrictions on the left there. Once you're in South Africa, you have limited opportunities regarding where you can invest. And whilst you're abroad, you have access to offshore accounts, international investments without restriction, but not when you're back in South Africa. And so obviously just be aware of these opportunities and take advantage of them, should they be sufficient or correct for you. Over to the right there, that property purchase, which is another thing that Mariska was mentioning earlier, which we're getting a lot of queries about. So have you thought about if you want to purchase your property, purchase for residential or investment purposes? That's another key thing. And then how to structure the purchase or ownership based on who would be the beneficial owner, where they would be, and then obviously to minimize that tax for them. This is often a consideration when passing on to our kids or our spouses. There's different structures for different uses, such as if it's multiple properties for an investment purpose, commercial property. We can use structures such as trusts, companies, or even sometimes it might be best to just keep it in our personal name. But again, each is specific to you. One last thing is just to understand the tax implications, being a non-resident and owning a South African property. And in the different areas we get taxed, obviously with the purchase or the sale, on the transfer duty, withholding tax, capital gains tax. Again, these should all just be taken into account when making an investment property purchase decision, okay? And be aware of these at the outset as opposed to having any surprises later on. Then the tax environment, again, from considerations wise, with high levels of disposable income, this being your monthly income that's left over after all of your expenses. and saving of thousands in taxes each year being abroad or in Dubai, Hong Kong, or Singapore in particular, there's a distinct opportunity to just take advantage of whilst we are offshore. Understanding this and ensuring your savings are maximized for your time out of the country is why we're all actually working abroad in the end. Succession and intergenerational planning, the last one. Walking the journey with you and your families, ensuring you have the right structures in place, again, basic wills, the beneficiaries of your estates, etc., all reading in the same direction so that when we do pass on, that the courts are not determining where and how long it takes to disperse your wealth within your wishes, especially if we are supporting partners, children, or dependents. And again, we don't want SARS to kind of have access to everything. And then, yeah, so that brings us to the end of the presentation today. And I'll just pass over to Fred, as I see there are a couple of questions that have continued to pour through, and we can just try and touch on as many of those as possible with the remaining time. I've got about 10 minutes. So, Freddie, do you want to take us through one or two of those that have come through?
Yeah, sure. Thanks. Great, Sam. So we've had a couple of questions. I'm conscious of time, so we'll try to get through as many as possible. If we don't get through any of the questions or we don't answer your questions, we'll be in touch with you. Or if there's anything specific you would like more information on, please don't hesitate to reach out. So, Mariska, I think this one's probably for you in terms of, so my parents are in South Africa. I live abroad. And if I am to inherit money from them, will I personally be taxed on the inheritance when I receive it?
No. So generally how that works is either the estate will pay the tax and you'll receive the after-tax amount from the estate, or maybe if it was a life insurance policy where the person is a beneficiary of, the tax will first be deducted before it's paid out. So you won't personally need to include that in your tax return. It is included in the tax return, but it's non-taxable in the individual's capacity.
Okay, great. Thanks, Mariska. And then I'm an individual living abroad and would like to purchase a South African property. So back in SA, living abroad. What is the best way to structure something like this? Would it be in a trust or in my personal name? I think Sam touched on this, but Mariska, could you just kind of elaborate a little bit on that?
Yeah, so it depends on what the intention is here. If you are planning on just buying one property because you want, one investment property, then it might be best to just purchase it in your own personal capacity, because your individual tax rates are between 18 to 45%. So if it's one property, it could be okay to just buy it in your personal name. But if you're looking to create a property portfolio or maybe commercial property where, there'll be more than one property, or you'll have a lot of income coming in, then it's best to have a structure. So the structure that we always recommend is that you have a family trust of which you and your family, or whoever, your kids, whoever, are the beneficiaries of the trust. The trust then owns the shares in a company, and the company will then own all the properties that you buy. And the reason why we set it up this way is because a company pays a flat rate, tax rate of 27%. So where a trust, you don't ever buy it directly in the trust, because the trust pays 45% tax on the income and 36% capital gains tax. So the company at 27% and the capital gains tax is 22.4%. So it's lower than just outright buying it in the trust. So in this way, you'll save in tax, and then whenever everything is sold or you want the money as the beneficiaries, the trust essentially owns these properties because it owns the shares in that company. So you can then get dividends from the company to the trust, and the beneficiaries can in that way get the funds.
Yeah, so I think that just highlights the importance for receiving qualified advice and getting opinions on these things before, and being ahead of the game. Otherwise, you can end up paying a fair amount of tax. Do you need to formally apply to cease tax residency in South Africa, or is it automatically determined based on the residency test when disclosing worldwide income? Additionally, so is worldwide income above 1.2 million still taxable in South Africa?
Yes. So if you've not ceased your residency with SARS, you're seen as a South African living temporarily abroad, and you'll be taxed on your worldwide income. So the 1.25 million rand will be exempt, and the balance will be taxed in South Africa. But really it shouldn't work that way, because the requirements for the 1.25 million rand exemption is you must be a South African tax resident, you must be out of the country for 183 days, of which 60 must be consecutive, and you must be in an employment contract. Then your 1.25 million rand is exempt. So if this person has been living abroad for 5 years, they would meet the tax treaty rules actually to break tax residency in South Africa. And for that reason, they're not a tax resident, their worldwide income is not taxed in South Africa, and they actually don't need the 1.25 million rand. So I think that just takes it back again to how important it is to seize your residency, because your foreign income does not need to be taxed in South Africa.
Thanks, Mariska. Going back to some of the trust planning and trust advice, can I still use a South African trust to hold offshore assets, or should I rather set up something abroad, for instance?
Yeah, I won't recommend holding your foreign assets in a South African trust. It's just going to cost too much tax in South Africa unnecessarily.
Okay. And then Sam, I think one for you is, if I own a property in South Africa, I live abroad and plan to return to South Africa in the future. Are there any key things that I should be looking out for doing while outside of South Africa?
Yeah, thanks, Fred. Yes, I think as a first port of call would be to reach out to someone like Mariska, just ensure you have the correct South African tax status. Then, once you've established your correct tax status, you then need to understand current and future potential intentions, jurisdictions, or countries which you may end up living in. And then, regarding the South African property, you will still be liable to file and pay annual returns on the net income portion of that property in South Africa. And then regarding your international status and options, are that once you're in the correct bracket from a South African perspective, whether that be the temporary resident abroad, resident or non-resident, we can then take a look at finding some tax efficient or compliant investment solutions over the time frame that's required, which are all specific just to an individual circumstances. So in short, yeah, pretty much contact your financial advisor, go through a full review and understand the steps to follow with them or your trusted partner. I think it's good starting point.
Perfect. Thanks, Sam. And is there a limit, Mariska, to how much you can send overseas? I know you mentioned that there's the 10 million rand that you have to get, in essence, special approval for. But ultimately, the question is, so is there a limit to how much you can transfer abroad?
No, there's no limit. So the first 10 million rand, essentially you can send 11 million out without special approval. And then over 10 million rand, you need to apply for a special approval, which it's just a more in detail process with SARS. It's normal AIT PIN takes about 21 working days to be approved, but a special approval takes about 3 months with SARS, and then it can take up to another 3 months with SARB as well. So they do like a lifestyle audit. They make sure they see where did this wealth come from. So just like an in detail audit to send more than 10 million rand, but there's no limit for that.
Okay, perfect. And just one last one in terms of tax residency. Can I still keep my South African bank account and South African investments if I seize my tax residency? And are there any implications?
Yes, so you can keep it. The bank just needs to be informed that you are a non-resident now. They'll change your bank account to a non-resident. You can still have transactional access on it, but you'll just have that status of non-resident. And then you can keep your investments. It's just important to note that any income that you earn in South Africa from that investments will still be taxable in South Africa, because non-residents are taxed on their South African source-based income. So if it's property and rental income, you'll pay tax in South Africa. If it's dividends, you'll pay tax in South Africa. If it's interest, non-residents actually get an exemption from interest in South Africa when it's from an institution, such as maybe Allan Gray or the bank or something like that.
Okay, great. Thank you. So that brings us to the end of our presentation. As I mentioned previously, if you would like any further information or advice on your own personal circumstances, please feel free to reach out to one of us, Sam, Mariska, or myself, or there should be on the slide now, you can scan a QR code to arrange a chat. And lastly, thank you very much for everyone to joining our session. And a special thanks to Mariska for the great tax information and some of the great examples you went through for that. So thank you everyone for joining today.
Thank you very much.
you.
Thanks, guys.
Perfect.